Hello, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been specialist inheritance tax planners for more than 18 years, and this video is all around family investment companies. So really it only applies to people who have estates which are likely to exceed 2 million. So the question is do you have a large estate valued over 2 million? In that event, a family investment company may be a great solution for you, and this video will explain the advantages and disadvantages of that particular solution. So, cue the intro. Okay, so what exactly is a family investment company? It's basically a normal company with bespoke articles of association and multiple share classes. Now it's usually limited, but can be unlimited if only investments are held and not property. Now it's specifically set up by tax consultants together with lawyers to match the family who's investing the money into this particular strategy. So it's mostly used by people who have large property portfolios, and really it doesn't matter if your property portfolio is 2 million or 20 million. It's still possible to utilize this mechanism to avoid nearly all the inheritance tax, and in most cases all. So how does it work? Very simply, if you're just holding your properties as an individual with your wife, for instance, and you manage them yourself, it's very simple to set up a registered partnership with HMRC. So it's registered as a partnership as opposed to you just doing your tax returns individually. Then, after 3 years of that partnership being set up, and when you set up the partnership, there are no capital gains tax issues because it's still a personal taxation regime. Okay, so 3 years after the registered partnership is in place, you roll that over into an incorporated family investment company. Now at that point you can get something called Incorporation Relief, which will save the CGT and the stamp duty land tax. So it's a very effective mechanism to get rid of that particular problem and put it into a property. So it's also useful for clients with potentially large investment portfolios, but as I said, for people really with 2 million and above. And again, shares are gifted as fast as possible into the company to avoid CGT once again. So how's an FIC set up? Okay, the people gifting the money and the assets, the property or the investments into the company will generally have A-class shares, and when they gift the assets into the company, it's offset on the balance sheet as a director's loan. Now, the people who set it up become directors of the company and therefore they retain control. Now, the director's loan repays the money over time, but because it's a loan, the money that you're getting back is actually free of income tax. So if you've got a property portfolio, the properties are generating the income in the normal way, but it's the money that's coming in, instead of being paid as liable to income tax on you, is just paid into the company. Profits are chargeable to corporation tax, obviously, but that's at 19%, which is generally lower than people with large property portfolios who are paying 40%. And then the money comes out tax-free. So this alone will save thousands of pounds in income tax over the years. Now, at around age 78, because we're saying, okay, people die around about 85, we want that 7-year gap, any remaining director's loan is given up as a potentially exempt transfer, and providing the directors survive 7 years, that will be free of inheritance tax. Now, as I said, corporation tax is payable, but it is at 19%. Now, as it's a company, Section 24 on buy-to-let properties, if you don't understand what that is, look it up. But basically, it only allows a 20% tax credit against mortgage interest. And therefore, because it's a company, all mortgage interest will be offsettable against the income. And as I said, You can also get an income as a director. So say you've given up all the assets and you've given up the director's loan, or the director's loan runs out, you can still get an income as a director and a controlling director of the company. But you only own the A shares. Generally speaking, your children would have the B and C shares, and those B and C shares would then have the growth in the company over the number of years that the company is in existence until you effectively die, or you give up the director's loan, and then that's back into the company, and that's fine. But all growth is outside, and when you give the money away, or your shares and the company away, that effectively wipes out the inheritance tax after 7 years. So that's how that works. Now, although your adult children will have B, C, and sometimes D shares, the children are not directors. So the main point is for the person gifting the money to retain control. Doesn't mean that children can't become directors down the line, but one of the massive benefits of an FIC, a family investment company, is that the rules and the articles of association say that only children, direct descendants, children and grandchildren, can own shares. So if one of your children were to get divorced, the control in the company is retained within the company, because the rules say nobody else is allowed to retain shares. So that gives you additional set of protections. It doesn't necessarily mean that the law courts, of course, the divorce courts couldn't offset against the values. We get that, but it's about the controlling the regime and controlling the assets within the company for the long term. So a family investment company is really good for people with assets which exceed 2 million or 1 million excluding the main residence, depending upon your overall asset base, but generally 1 million excluding your main residence. So it's good to potentially eliminate inheritance tax on large estates, and that's what it's there for. But there are risks, because obviously it's an ongoing company, and HMRC, if lots of people start to do this, could eventually start to attack these type of companies, and therefore you shouldn't rely on this mechanism only. So what are the main benefits of a family investment company? Well, firstly, you avoid capital gains tax on passing your property portfolio into the company, provided it's done correctly. So be careful, it's got to be done correctly. It can generate very low levels of income tax, and for some people who are used to paying a higher rate tax on a bigger property portfolio, this will be a godsend. And also it does avoid the inheritance tax, which is the main point, while retaining control within the family. So some major benefits around a family investment company. So what are the negatives around this particular strategy? Well, as I said, it does have the potential to be attacked in the future by the HMRC. Now, at the moment, it's fine. And to be honest, if you've got a huge property portfolio, your estate is massive, you can only give 650 as a couple into trusts every 7 years. So really, unless you go into higher risk investments like business relief plans, you're a little bit limited as to what you can do, and this certainly works. But as I say, there is a potential to be taxed in the future by HMRC, which is highly unlikely with the trusts. Income can be inflexible, I suppose, because it's based upon property income, if that's what the issue is. Of course, the company could sell down a property, have a lot of cash sitting in the company, and therefore have quite a big adjustment on the income if required. Obviously, of course, there are accountant fees to manage every year. There's corporation tax, but as I said, corporation tax is at a lower rate even than basic rate tax, so no negative on that particular front, because you're not withdrawing the money generally as income unless you need it when you take money as a director. So there are negatives, mainly the potential for attack from the HMRC down the line. Okay, so what are my recommendations? Well, don't rely only on a family investment company. Always consider your other options. So for instance, make sure you use trusts, put the maximum into flexible reversionary trusts. If you're unsure what that is, look up one of our other videos. You could put some amounts into business relief plans. There are some, we have to classify them all as high risk, but effectively they carry different levels of risk, and that will be clarified by the independent financial advisors. but it does make more capital available by having more in. So depending on your age, if you put 650,000 into trust and maybe you have a few $100,000 in business relief plans, that will give you access to about $1 million should you need it, and then the rest can go into the family investment company and you've done pretty much all you can do. Okay, so as I say, place the maximum into a flexible reversionary trust because it is a huge backup in case you need care down the line or if you need money quickly. It's much more flexible than properties within a company. And also, at some point, as I said, at age 78, we're looking to give away the assets within the director's loan and the properties, and all we then got is an income stream as a director, and that may not be big enough, and therefore this million or so backup gives you a huge amount of flexibility into your later years. But it's also the peace of mind of knowing that will definitely be out of your estate, and at least you've sheltered 1 million totally effectively in the long term, because there's very little doubt that there'll be a problem with any of those. It's just so unlikely to happen. So for some landlords, this is difficult to get the concept to not to have everything in property. But it's always a balance of all the different taxes and the returns. And what we're saying here is that you need the peace of mind to have a big backup when it's not all in your property portfolio, when it's not liquid. Because if you keep it, it's going to get charged at 40%. So better to give up a little bit of return. And actually, would you even give up a bit of return is open to debate with the tax advantages and the income tax advantages. So always worth looking at the full solution, not just an FIC on its own. Very rarely is that good for a person only without anything else. So that would be our recommendations. Okay, so that's a family investment company. In summary, it's very good for people with large estates because there are few other options to solve such a big inheritance tax problem. Large gifts to children, of course, is a possibility, but of course the moment you give a large gift of several million to your children, they get divorced, 50% of that money is going to walk, right? And also it's going to be in their estate for inheritance tax as well. So I would suggest you always use the maximum amount into trust. You use business relief plans also as an extra addition, depending on the amount of capital you're happy with holding on to in the long term. But the main point of the trust and the business relief plans is you get certainty on IHT avoidance, which cannot be said for family investment companies at the moment. So it's a toss-up really. But at the moment you've got not much other choices to get rid of a massive estate unless you give it to the children directly. And as I say, they get divorced, there's your problem. So thanks very much for listening. That's family investment companies. If you enjoyed that video, there's lots more around inheritance tax, but please like and subscribe, and I'll see you in the next video. Thanks. Bye for now.